The fourth basic flavor of accounting is income tax accounting. Bookkeeping, gather the raw data. Financial reporting, we're reporting to people outside our company who might want to loan us money or might want to invest in our company. Managerial accounting, it's the detailed stuff that we use in our company every day to make decisions. Income tax reporting, that's accounting done to satisfy our legal obligations. So let's talk about income tax accounting. You may have heard before people talking about big companies, well, they keep 2 sets of books or they keep 5 sets of books. Well, how many sets of books does a large U.S. corporation keep? And we're not talking about doing anything shady here. Legitimately, how many sets of books does a large company keep? Any large company in the world keeps 3 sets of books. Of course, there's one underlying bookkeeping system that generates all the data, but then different reports are prepared for different purposes. First, there are the financial set of books, if you will. Those are the reports that are provided to outsiders, banks, potential investors, the financial reports. So that's one set of books. Next, there are the managerial accounting that we use every single day, those detailed data that we use to make decisions. You can call that another set of books. 2 different ways to use that same underlying bookkeeping database used by insiders, the managerial reports. Third, we use the same raw bookkeeping data to fill out the tax reports to be in compliance with the law of our local governments. That can be said to be a third set of books. And I hope it doesn't surprise you to learn that the financial accounting income that you're going to report on your financial reports to your banks and your shareholders is not necessarily the same number as the tax income that you report to the government. You say, well, I'm shocked to hear such a thing. No. The financial reports are prepared to give economic information to potential lenders and potential investors. That's the purpose of those. The tax reports are merely designed to satisfy the law. There are 2 different purposes, 2 different sets of books, and we add the third set of books, those detailed internal managerial reports. Large companies keep 3 sets of books. Let me give you the conceptual idea around and about income tax reporting. At one end of the spectrum, we have economic income. Economic income is based on value changes. What am I worth? How much is my house worth? How much are my investments worth? Economic income measures the ebbs and the flows in the worth of an individual, the worth of a company. That's one extreme. But that's kind of subjective. I mean, what am I worth? Well, that's an interesting question to ask. That's economic income. At the other end of the spectrum is cash flow. How much cash did I collect? How much cash did I spend? There's no subjectivity there. That's very objective cash flow. Those are the 2 extremes of measuring the performance of a company during the year. The subjective value changes of economic income and the objective cash flows. Well, accounting income and taxable income fall somewhere in between. Accounting income is an attempt to get as close to economic income as we can, given the practical constraints that subjectivity has to be constrained a little bit. We call it accrual accounting. Let me give you an example of this idea of accrual accounting that's used in measuring accounting income. Let's say I earned $20,000 this year, but I'm not going to collect that $20,000 in cash until next year. I earned it this year. I did the work this year. I'm going to collect it next year. Well, do I report the income this year or next year? This year when I did the work or next year when I collect the cash? Well, the idea of accounting income, accrual income is don't follow the cash. Don't follow the money. Follow the effort. Follow the creation of the economic value. So for your accounting records, for financial accounting, for example, you'd report the income this year when you actually did the work. See, that's more towards the economic side of things. Let's report the economics. Did you create the value this year? That's when you're going to report the income. Taxable income, on the other hand, is towards the cash flow end of things. Taxable income is when you collect the cash, that's when you report the income. You've experienced that as you filled out your own tax return. Now, why would taxable income be closer to the cash flow objective end of the spectrum rather than the economic income subjective end of the spectrum? Well, because taxable income, it's a legal report, and I want to be able to tell whether I've obeyed the law or not. And if we're measuring subjective economic values, it's hard to tell who's right and who's wrong. Where if it's just cash flow, that's very straightforward. So it reduces arguments. It makes it so people can tell whether they're obeying the law or not. Also, there's the idea of the ability to pay. I should pay tax when I have the cash to pay the tax. Yes, I earned the income this year, but I can't pay the tax this year because I haven't collected the cash yet. Wait until next year when I collect the cash, then I can pay the tax. So that's another idea behind taxable income. The third thing, and I won't say anything more about this than this brief statement, the thing that makes the tax rules complex in any country in the world is the social tinkering that legislators do through the tax code. We want people to own their own homes in the United States, so Congress has said you can deduct the interest you pay on a mortgage loan on your own home. That encourages people to buy their own homes. We want people to donate to charities. We give them a tax deduction if they donate to charities. These are good things, and the tax code is an interesting way to tinker with what happens in our society, but that's what makes the tax code complicated. So here you see the simple difference between accounting income and taxable income. Accounting income is a little bit more of an economic measure. Taxable income is a little more objective towards a cash flow measure. In 1934, Judge Learned Hand made the following observation. Over and over again, courts have said that there is nothing sinister in so arranging one's affairs as to keep taxes as low as possible. Everybody does so, rich or poor, and all do right. For nobody owes any public duty to pay more than the law demands. Taxes are enforced exactions, not voluntary contributions. That's a very oft-cited quote there, and it's a key point. Income tax accounting is all about obeying the law. What do the laws say about how much tax I owe? Let's make sure I pay that tax. I'm not obligated to pay more than that, and it would be illegal to pay less than that, so let's pay exactly that. So income tax accounting all swirls around making sure we understand the rules and we're obeying the law.